Good day, my name is Gabriele Susingo. I've been kindly asked by Daniele to chair today's event. Actually, I'm pretty honored to open the 8th Quant event organized by Diamond. It is absolutely a pretty impressive success. It is a unique opportunity to meet practitioners and academic studies, and I'm very happy that this takes place in Venice, because it's a city that I think everyone of us likes. I don't want to take too much time, but just focusing on little observation on the role of quant activities nowadays. You have people who do not know or understand what quant is and say that we are eager. While understanding our job and the potential of our approach, it means that we have a lot to bring to the financial world and to the stability of the financial system as well, because we tend to understand things, not just to sell them. In my activity, I've been noticing a regain of interest of some simple quantitative approaches. Most of them are what I would call expected return independent allocation. Those with all this family of allocations, we do not rely too much on returns expectations. And the leitmotif that I've been observing last year on institutional investors was people asking for simple and robust quantitative approaches. And so having a lot of regain of interest of all those strategies, which goes from mean, VAR, equally risk contribution portfolio, most diversified portfolios, all those things you just rely on an assessment of correlations, eventually just ensemble average of numbers and assessment of volatilities. And there is also a regained interest of trying to detect some mean reversion pattern and cyclicalities that could exist in the market. And so those are the two fields that I saw quite sizable interest from institutional investors, at least with the bias of our clients. For Unigestion, which is a fund management company in Geneva. And funny enough, which is pretty much also the leitmotif of the subjects we covered during this conference. So I do not take more time from the next speaker, who will talk about enhanced optimal portfolios, pretty much in the line of what I've said, I suppose. And let me welcome Lars Kaiser, which is a research assistant and PhD candidate at the University of Leiden, which will talk and entertain us on efficient portfolios.
Okay, thank you very much for the introduction and inviting me as a speaker. As you already said, basically this study is conducted research at the University of Liechtenstein. Three of us basically, my supervising professor and two PhD candidates. And so I'm just going to present you what the idea is basically of our paper. Now, as you can see, the title is Enhanced Optimal Portfolios, and now some of you may already wonder, well, if something is optimal, how can it be further enhanced? And you're quite right in thinking so. Hopefully throughout the next 20 minutes I can explain to you why we've come up with this title and why it can actually make sense to enhance an optimal portfolio. Let's just start with the motivation. Now, there's a wide range of literature talking about predicting stock returns, for the one hand. And, well, it's not all, not everyone is on the same page on that kind of topic. So some researchers have found evidence that, well, it is possible to forecast stock returns successfully and also implement them in the portfolio management process somehow. And other researchers have said, well, no markets are efficient, and over the long run you won't be able to accurately predict stock returns, and I guess that is something that is part of the whole problem of active asset management, that a lot of people actually believe, well, you know, it's not really possible over the long run to generate consistently alpha. Now, Cochrane actually in 2008 described something that he calls a catch-22. Now, the idea behind that is that, well, if it is possible for some kind of period to actually predict stock returns using quantitative predictors, then over the long run, everyone's going to buy into these kind of predictors, so the phenomenon disappears over time. Okay, so that's the idea basically. If markets are efficient and then we include these kind of factors and they are priced, then this effect of actually generating outperformance based on these factors and predicting stock returns will actually disappear. Now, if the output of any predictive estimation will sooner or later become obsolete and disappear, now the question is, are they actually any good for portfolio management? Now, if we just do empirical studies and say, okay, for some time it works, but for other it doesn't, then that's fair enough. It's kind of back-looking, and it doesn't really help us for portfolio management. So what we have to do in order to actually use these factors is we have to account for their predictive quality over time. So there's a time variation in the predictive quality of some factors, and we have to account for that in our optimization process in order to make them actually worthwhile and actually generate some kind of alpha with these kind of factors. So the idea we had to apply statistical properties of the estimation to portfolio optimization. And as we'll see, in our case, for the standard setting, we just use a simple linear model and basically take some of the statistical measures and incorporate them in the optimization and thereby account for this time variation. But I will go into a little bit more detail on this in a second. Now, in general, we define an optimal portfolio as a market portfolio. Now, usually, I can tell by a lot of faces that people are not very happy with that. Now, for our case, we do so because we're actually going to apply a model that is called, our study is based on a model called Black-Litterman model, which most of you probably know. And what they have done is actually, well, they discussed that a simple naive one-of-n strategy or using sample-based estimates, etc., are not really as good as taking market-implied returns for this case, but I'll look into this in a second as well. So this is the basic setting. Our kind of benchmark and starting point is therefore the market portfolio and the market capitalization weights that come along. We assume an investor with a constant relative risk aversion, which has a risk aversion of 1. This is basically for simplicity, as we show, it kind of turns the whole process into a multi-period process, but shouldn't be anything too special or too fancy at this point in time. And as we say, in this model, we hold this optimal portfolio and we have enhancements, so we have additional information coming in from quantitative predictors. Now, the question is, how do we combine both of them? Therefore, we use Bayesian estimation, Bayesian separation based on the original Black-Litterman model. They actually refrain from referring to the Black-Litterman model due to the fact that the intuition behind it is actually quite different. Now, in the original Black-Litterman model, you also have prior, according to the implied returns from the market portfolio. However, you can incorporate subjective views, and we kind of, in our process, we remove this subjective input and then replace it as a quantitative predictor, and we can thereby also define certainty levels as a statistical measure, which has been previously always been a subjective way of constructing a model. So we start off by calculating implied returns. We can do so using a reverse optimization procedure, which is pretty standard and quite popular. And thereby we get the implied returns, basically the returns that are applied due to the market weights in the market portfolio. What we do in the second step is we specify our quantitative predictions, and we have corresponding certainty levels alongside. So we use our OLS estimate using different factors, as I'll show you in a second for the empirical study. And what we can do is we can actually assign certainty levels to these views that are generated from the models, and thereby account for this time variation in predictive power of different factors, as explained in the beginning. Now the posterior, which is basically the combination of the originally implied return from the market and our new weight, or our new expected returns from our quantitative model, they can combine in this standard formula. It looks slightly different than the original Blake-Litterman formula, for those of you who are aware of that. But this is due to the fact that we only use absolute views. That basically means that for each period in time, we have an expected return for each single asset. And therefore, we can drop the identity matrix that is included in the original model, which makes it slightly more simple. And basically, as you can see, it's quite obvious that our new revised posterior conditional distribution is basically from a sum of our original implied returns from the market plus the difference, the weighted difference between our expected return and those implied by the market. So this would be the excess of our expected returns over the market implied returns, and we weight them according to this fraction. And we'll look into that fraction in a second. And finally, we go back to the original optimization and can actually back out the new revised returns based on this model. As I said, the estimation model is pretty simple. We use a 1 million least squares estimation, as we show here. However, it's no problem to actually include alternative models as well. That means we can also make use of a multi-factor model, as we use in, as you'll see, we use adjusted squares right from the beginning, which of course is not really relevant for the case where we have just one factor model. However, in order to make it possible to include multi-factor models, we work with adjusted squares right from the beginning. We've actually looked into using maximum likelihoods as well, and that seems to work as we are currently progressing on the paper. This is something we'll also include for the future. We make use of a rolling window approach for the estimation, as well as for the covariance matrix. Now, of course, we know using a 36-month window for the covariance matrix is not ideal. However, given the fact that we are actually focusing on increasing the accuracy of the expected returns rather than focusing on the covariance matrix, we thought this would actually be fair point to just use a sample-based estimate for the covariance matrix. And then finally, as all of you know, we take the squared measure, the difference of fit of the regression, which will then be the kind of measure that we plug into our omega, which describes the certainty levels we assign to these different estimates based on our linear regression. And basically what we get at the end is we have these expected returns from our linear regression with respect to here, and we have omega, where we take basically for the diagonal elements, we take 1 minus r squared, because from the original formula that omega is defined in a way that the smaller omega is, basically means that less uncertainty is assigned to these views we generate from our linear regression. Therefore, as r squared gets bigger, as our confidence in these expected returns generated from our quantitative model increase, omega actually gets smaller, so we are in line with the standard setting and thereby can apply these measures into the model. Now, this is basically the model so far. It's not really complex in that we are basically just building up on top of something that has already existed. However, the interesting part is that we basically remove the subjectivity, and that also there's a direct connection between the confidence levels assigned to the return predictions and the actual return predictions that are generated based on this linear model. Now, what we do is to actually test whether this model works as well, or whether it's just a nice idea that we had. We run a simulation. For 100 years based on the monthly frequency. So we have around 1,200 data points per asset. We do that for a case of 2 assets, with returns for asset A and asset B. And we have an independent variable f that we use as our predicting factor. Okay? And what we do, I'm not going to go into too much detail because this is pretty standard. We simulate assets A and B depending on each other, so they will covary over time as we would expect in the case of, let's say, 2 equities. They would have a certain kind of covariance to each other, and we would expect that to range the correlation between these two assets to range between 0.5 and 1. So this is the kind of level they can range. And in the second step, we have a predictor that is simulated with the correlation on the asset return or the expected returns of asset A. And so in this case, however, the range can be between -1 and 1. So the predictor, as is realistic in that case, can have periods where it works really well, and it can have periods where it works really bad. And this is basically the idea, coming back to where we started right at the beginning, this time variation of predictability and the factors quality. So this is what we're trying to replicate here. Okay, I think we can still go, we said most of it already. If someone's interested, I'm happy to come back to that later. I think, let's look at the result. What we predict here is basically, let's start from the bottom left. So what we have here is the correlation between the predictor and asset A in our simulation. So therefore, we can see that as the quality of the predictor. Okay, so these will be our R-squared values, and we can see we start off from the beginning. We have R-squared around 0, so correlation basically is very low, which would also mean that confidence in our predictions is low, and we wouldn't expect any deviation from our enhanced portfolio from the market portfolio that is quasi-optimal in our case. And this is basically what we can see. The lines here are identical up to the point where we actually see a break in the correlation. And what happens now, the correlation between predictor and asset is actually really high. It's close to 1. And what that implies, obviously, is that the predictor actually entails some predictive quality for the next period, and that actually our model should work pretty well and that it can explain our returns. Now what we can see here is exactly this. We increase, so the gap increases as we move to a higher correlation level, and it picks up. Okay, so this is the accumulated portfolio performance of the enhancement, and it picks up. Now, so far it's nothing special. The interesting part is actually where the break now, we have a downside break again, where the correlation between S8 and the predictor is now around 0 again. Now what you have with standard models that rely on quantitative predictors in portfolio management is that you're not really assigning a confidence level to those, in that you account for the time variation, their predictive quality. Now usually what you do is you do a back test, you say, okay, this factor entails some power to explain tomorrow's equity returns, for example, and then you would apply them and base your model on that. However, from Cochrane we know that, well, it's fair enough that it works for a certain period of time, but it doesn't work for always, so what we have to do is account for that. So what we want is, and this was our weighting factor, if we come back to the original formula, you know, we have the implied returns plus the excess of our linear model, so the expected return, and we have the weighting factor. And what we want to do is that in periods where our predictions are good and working well, we want to move and shift our posterior basically towards our linear model imply implied return expectations. And for the cases where we know that the predictors don't work well, we just want to basically stay in the market, implied returns, stay in the market basically. And this is exactly what we can see here. This is where we go from a period where predictions work well into a period where there's actually a break of predictability. So again, after that, correlation between SK and the predictor are close to zero. The model doesn't actually lose this previously generated return, but due to its shift into the market portfolio, it can actually retain it. Okay? And this is actually the interesting finding that we have. Of course, this is in a perfect world. Returns are normally distributed, etc., which is why it works so well. We'll see in a second that it does also work on empirical-based data, but obviously not significantly. But this is the basic idea behind our model, that it kind of adjusts basically to this predictability in factors. And we can actually see that here pretty well as well. We have here the number of correlation breakdowns. So over our 100 years, for the maximum case, we would have one correlation breakdown more than every 10 years. And what we can see is that starting from a level where, in this top corner, where we have zero number of correlation breakdowns and a low variance in the predicted throughout a period of correlation. So that would be this variance here within one for one K period of correlation breakdowns. And what we can see in the ideal case, where we have no correlation breakdown and the variance between within such a K period is small, this is where our alpha of the enhanced optimal portfolio based on the Zoom prediction is the highest. As we move along, we can see that as the number of correlation breakdowns increases, we move down, so we lose on alpha. That makes sense because the model kind of has to adjust, and the likelihood of having correlation around zero is higher. At the same time, we can see as the variance within such a K period of the predictor increases, our predictability goes down as well. However, what we also see is that it never goes down below zero. And this is the intuition we have behind the model, is that where the predictor works well, the model goes into these predictions, makes use of them, and can actually generate an excess return. However, in periods where it doesn't work well, we go out of the model and go back into the market portfolio, and thereby are able to retain the excess return generated in previous periods. Same picture here, again, we plot it two-dimensionally, and you can see it's consistent. There are some variations in here. Meanwhile, we've actually run it again for 2,000 periods rather than 100 runs, and it's a lot smoother, the picture. The tendency is the same, but just a lot smoother over time. So we won't see any of these little dips, which is caused by a rather small run of simulations. Okay, so far so good. So it works in a perfect simulated theoretical world, but obviously most of you are more interested in what actually happens if you apply it to real data and do some out-of-sample tests. Now what we do is we make use of 8 factors. We use the Baltic Dry Index, which is maybe known to some of you. It's basically, there was a paper by Bakshi et al. And in 2011, and they showed that this Baltic Dry Index, which is kind of a shipping index, works pretty well at predicting some kind of equity returns on an country index level. And then we use some other economic variables like industrial production or industrial production for manufacturing. However, for this model, we are actually less interested in the quality of these predictors that we apply, but whether the model actually works. So where the predictor is bad, we should be in the market. Where predictions are good, we should positively deviate from the market. Okay? So we apply that to a portfolio of 22 FTSE country indices. Again, as we know from before, implied equilibrium returns are based on our market cap weights. We use our observation period from 88 to 2012, and predictions are based on 3-month long growth rates, which is basically derived from the Baltic Dry Index because that yielded the best results for that factor. And we just kept it constant again because we're less interested in the quality of the predictions rather than the model's performance. And what we can see here is same depiction as before. This we've plotted the perception R-squared values over time. What we can see here is R-squared values are rather low. Okay, there's a period where we have where actually the R-square value of the case for the PDI actually increases quite significantly, which is has been empirically shown that in periods where amount volatility is rather high, that actually also quantitative predictions work better. What we can see here is again actually obviously at a smaller value as before for the simulation, but what we can see is again that not perfectly, so we have periods where there is some kind of R-square value that's very low. The model might slightly go below the benchmark where it adjusts at the beginning, but as we can see, periods below the benchmark are very low. These are consistent results for all factors, although I'm only presenting for the PDI at the moment. And as you can see here, for periods where R-squared increases, so our confidence into these predictions and the quality of our predictions increases, actually the positive deviation increases as well. And interestingly enough, after a period where R-squared values are high and it drops again, the model again is able to retain a large portion of what has been previously generated. So from that perspective, also in the empirical setting, our results that we show for the simulation are confirmed, although obviously not at such a high level as in the ideal world and normally distributed returns. Now, let me quickly, I've got like 1 minute left. Let me quickly also show you what we've done in terms of the parameter tau. The parameter tau actually can be seen as some kind of confidence towards our market implied returns. Okay, so we have omega, which is the confidence associated with our quantitative predictions and the expected returns yield from there, and we have tau, which is the confidence in our market portfolio. Okay. What we can see as we play around with tau and as we increase tau, basically, what happens is that our tracking error above the market portfolio, relative to the market portfolio, increases almost linearly, so it's like 0.98 something if I have it correctly in mind. And what we can also see is that this is sort of the excess return of the enhanced portfolio over the market portfolio and the excess risk of standard deviation above the market portfolio. What we can see is actually for small values of tau, so for those below 0.5, we can actually manage to decrease portfolio risk whilst increasing excess return, which again sounds surprising in the first place, but however, given the fact that we have an unconstrained investor here, it is well known that a certain degree of short selling can actually lead to a decrease of portfolio risk. The interesting part, however, is with respect to enhanced indexing, this relationship of tau being almost linear, so that we can actually specify tau in a way that we predefine our allowed tracking error for our enhanced portfolio, and thereby respectively get a respective return and portfolio risk. We tested for low partial moments because we were particularly interested, of course, if our model is the standard deviation is likely to be high because we obviously got some upside potential. So we focus on low partial moments. What we actually find is that for the simulation, they will be almost equal to 0, and we can actually show for the case of the empirical part due to this Schrödinger just introduced that low partial moments is for some cases are actually smaller than for the original market model. Okay, so that's quite relevant as well. So concluding, I basically introduced this model that can account for this time variation of predicted factors, of quantitative factors, and the model basically allows us to make use of these factors, although there's a time variation in portfolio management, by accounting for that within the predictive model that we underlie in order to get this return estimates. Okay, thank you.
Thank you very much. There are questions from the audience? Please, Andrea.
Andrea Goraschi from My Horizon Capital in Milan. Can you say again how you calculate the confidence in your prediction, if it is based on the past performance of the past correlation between prediction and realizations?
Okay, so basically what we saw in the case of the simulations, we did exactly that, because we simulated the predictive factor F dependent on asset return A, which is basically used past correlation, that's right. For the empirical setting, however, we actually used the R-squared measure, so we based our OLS estimates on a window of 36 months up to point T, and then we had return estimates for point T plus 1. And in that case, we basically defined omega as 1 minus R-squared, which again is then plugged into the system as defined the uncertainty levels. Because again, obviously, the explained variance, the R-squared that we can use, is somehow a description of the predictive quality. So it is kind of a feature of the confidence we have towards these predictions. So it seemed intuitive to actually use it in that sense.
Another question? Actually, I have one. I find pretty interesting the jumps that you observe in the article. So, do you understand what produced this sharp jump, which looks like a phase transition for the empirical? Both, the one in the prediction side, for
the simulation, we enforce these correlation jumps.
I was expecting not to see it or as such a strong
The
output.
idea was that where you have correlation breakdowns when there's some kind of crisis, and that is the problem actually. So what we wanted to observe is, given that a factor loses its predictive quality all of a sudden, for some reason, we don't know, because it's priced, maybe because now all of a sudden the BDI is so popular and in the media that all of a sudden everyone trades on it and the effect disappears. Okay? It's this catch-22 that incorporates that. And therefore we included these jumps in order to account for that.
As a physicist, this will be the first thing that I try to understand. Myself, my instinct is to go and try to understand what has been the dynamics who has generated jumps.
Okay,
and its continues.
the problem is that when you backtest for certain factors that it's usually done, and you find some significance, most of the models just apply them as given and say, okay, we analyze the predictive quality and we make use of them. However, they disregard the fact that actually over a certain period of time this effect can actually disappear, and all of a sudden this fact but we still incorporate it in our model. This is what we're trying to do. We adjust for this factor, this time variation in predictive quality, using the S-squared method implicitly taking out the integration based on expected returns on. And thereby we can adjust it more quickly. Rather than, let's say, we have a meeting every half a year, and do a backtest, okay, it still works, or the next month we can actually lose predictive quality, but we still apply it for the next 4 months. So we can actually try it. This is exactly the thing we're trying to incorporate.
Thank you very much. Any other questions? So, if there are no more questions, let's thank our speaker, Lars. Sorry, there is a question.
My name is Julia Lutfi, I'm from Belgium, and my question is, to what extent is your model resistant to a period of stress, and what do you do exactly when the backtest fails?
Well, the backtest can't really fail. There is some predictive quality or there is not. And if there's no predictive quality, the factor that you apply will just stay in the market portfolio. That is the nice thing about it. So, of course, this is only interesting for investors that actually believe that the market portfolio itself actually contributes some kind of quality. Okay? So if you're totally against the market portfolio, it doesn't make sense to base a model on that. But this is exactly the case when you ask, if the predictive quality doesn't work, so we do a backtest and we have factors, and we can basically plunge all of the factors that you want. If you decide that this is a factor you're interested in, you can apply that and the model will adjust the quality whether it works or not. But you cannot lose, that is the idea, you cannot lose by applying a certain factor, you can only gain in periods where it works well. Where it doesn't work, you're still in the market, you haven't lost it. That's the kind of intuition behind it. Did that kind of answer your question, or did I get it wrong?
I was wondering if you apply any recalibration to the model without saying during this time it's not valid anymore, let's apply something else, maybe play with the parameters, just adjustments, recalibration, to make it work for a certain period.
We thought about applying some kind of time variation as well in the parameter tau, which is the confidence in our multipliers, because we could test that the same way. What we could do is we say, okay, so we have implied returns, we do a back test, we check how well these implied returns actually describe tomorrow's returns. There we can adjust tau as well. We have double effect. Okay? So what would happen if where our predictions work well, we have a lower omega, so more weight on our predictions. At the same time, this would imply that the market model doesn't work so well. So we can actually increase tau, because in this setting it's going to be all the way around, because we take the inverse of it in the formula. And what then happens is you have this double effect. And when we thought about that, however, the feedback we had was that actually it makes things not as intuitive anymore, rather than fixing some kind of parameters and focusing on others. And since our kind of contribution was that we adjust according to the explained variance, we decided to keep the other parameters fixed. But you could adjust this. In practice, you could adjust that. For explanatory reasons and presenting reasons in the paper and in the presentation, we kept the other parameters fixed.
Okay, thank you very much.